and our mission is simple: to help you forge a stronger portfolio and cut right through all the market weakness. Today, we're not just looking at a stock ticker. No, we are conducting a full-blown structural inspection of a pharmaceutical titan, Pfizer. The question on the table is as simple as it is critical. Is this company built on a solid foundation of rock, or is it just a house of cards, waiting for the next gust of wind to knock it all down? Let's get to work.
Just look at the headlines. Pfizer crushed another earnings report. They beat expectations on both the top and the bottom line. So by all accounts, the exterior, it looks fantastic. But the stock is just trading sideways, and the smart money, well, it seems hesitant. Wall Street is definitely spooked, and that's where the real work begins. When you decide to look past that fresh coat of paint, we're about to stress test every single beam, every pillar, and every support in this company to see if it can really handle the pressure that's coming its way. Okay, let's dive right into this number. This is what got everyone's attention, a 16.81% earnings surprise. They reported adjusted earnings per share of 66 cents, when the Zacks consensus estimate was pegged at only 57 cents. Now, to put that into perspective for you, that is the kind of beat that usually sends a stock absolutely soaring. It tells you that management is executing, they're managing their costs, and they are delivering profitability that is way above and beyond what the street ever expected. This right here is the shiny object, the curb appeal that gets investors interested in the first place.
Now, to do this inspection right, we need a blueprint. So here's how we're going to proceed. First, we're going to examine that shiny surface, those strong quarterly numbers. Then, we're taking out the thermal scanners and the sledgehammers to look for the cracks in the foundation. After we assess all the damage, we'll review management's rebuilding blueprint. And from there, we'll put Pfizer head-to-head with its competitors in a full-on structural stress test. And finally, we will deliver the iron financial verdict.
All right, Section 1, let's kick things off with the good news. The numbers that gave the bulls something to actually cheer about. This is the top-line data from their Q4 2025 performance report. It's really important that you understand why the initial reaction was so positive before we start digging into all the underlying concerns.
Now, what's really interesting here is the consistency. It's not just that they beat on earnings per share by a huge margin. They also blew past revenue estimates, pulling in over $17.5 billion. And this wasn't some kind of fluke. Pfizer has now surpassed consensus EPS estimates for 4 straight quarters. So management has built a real track record of setting achievable goals and then just knocking them out of the park. On paper, this is exactly what you want to see. It looks like a clean, solid performance.
Hold on a minute. A track record of beating estimates is great, I get it, but the stock has gone precisely nowhere. The market isn't buying it. So the real question we have to ask, the one every serious investor is asking, is this real strength? Is this a foundation you can actually build a portfolio on? Or is management just slapping a fresh coat of paint on a framework that's quietly rotting from the inside out? Because let's be honest, great earnings don't matter one bit if the core business is about to fall off a cliff.
That is the perfect question. And it brings us to the most critical part of this entire inspection. You're absolutely right, the market is forward-looking and it smells trouble from a mile away. So let's drill down past those flashy headlines and really look for those structural weaknesses. It's time to identify the cracks in Pfizer's foundation.
Okay, the first and by far the largest crack in this foundation is the patent cliff. And listen, this isn't some small fissure. This is a seismic event for Pfizer. For anyone who might be new to this, a drug patent basically gives a company a government-sanctioned monopoly to be the sole producer of a drug for a certain period, usually about 20 years. That lets them make back the billions they spent on R&D. But when that patent expires, the floodgates open. Generic drug makers can legally produce the exact same drug, and prices can plummet by 80 to 90%, almost overnight. That right there, that's the cliff. A massive, predictable drop-off in revenue from your most profitable products.
Let's put some hard numbers on this threat so you can see the scale. In 2027, the company is forecasting a revenue hit of over $3 billion, just from these losses of exclusivity, or LOEs. I mean, think about that. That's like an entire successful company's worth of revenue just vanishing in a single year. That's a massive hole that has to be filled, and believe me, it's only the beginning.
And this just brilliantly illustrates the accelerating pressure. The very next year, in 2028, that impact doubles. We're now looking at a $6 billion plus hit from expiring patents. So that's a $9 billion hole in revenue over just 2 years. This isn't just a headwind. This is a hurricane bearing down on their income statement. It is a structural threat of the absolute highest order.
And you don't have to take our word for it. This quote comes directly from Pfizer's own Chief Financial Officer, David Denton. He told investors flat out on their guidance call not to expect any top-line growth until 2029. Let me just repeat that. No growth until 2029. As an investor, what you're being asked to do is park your capital in a company that is openly telling you its revenue is going to stagnate for the better part of a decade. That is a really tough pill to swallow.
So here's the crucial point. While that patent cliff is eroding one major pillar of the company, another one is crumbling right alongside it. The massive revenue stream from their COVID products, Comirnaty and Paxlovid, well, it's drying up. The company itself is forecasting a drop from $6.5 billion in 2025 to just $5 billion in 2026. So that's another $1.5 billion in revenue gone. You've got the patent cliff on one side and the post-pandemic decline on the other, and it's creating this brutal pincer movement on their top line.
And this is what happens when the professional analyst community starts doing the math. Despite that shiny earnings beat we talked about, the trend in future earnings estimates has been deeply unfavorable. Analysts are looking at that patent cliff and the COVID decline, and they are aggressively marking down their expectations for the future. And that negative revisions trend is exactly what lands Pfizer a Zacks Rank of number 5, a strong sell. The system is flashing a giant red warning light, signaling that this stock is expected to underperform the market. Period.
Okay, so we've identified the cracks. They are deep and they are very, very serious. So the next logical question is, what's the plan? How does management possibly intend to repair this damage and reinforce the entire structure? Let's move on to their official rebuilding blueprint. This is where we find out if they have the tools and the strategy to not just survive this thing, but to actually thrive.
The plan has 3 core pillars. First, they are making a massive push to become a significant leader in the obesity market. This is, without a doubt, the hottest space in pharma right now, and they want a piece of that action. Second, they absolutely need to unleash the value of their drug pipeline, the next generation of blockbusters. And third, on the financial side, they're executing a massive cost-cutting program to the tune of $7.2 billion in net savings. That's to protect their margins while the top line is under all this pressure.
So what does unleash the pipeline actually mean in real terms? It means these specific assets right here on your screen. This is the future of Pfizer's revenue. We're talking about Padcev for bladder cancer, which just showed significant survival improvements in its trials. We've got MET-0970I, their big bet on obesity, a market that some project will be worth over $100 billion by 2030. Elrexfio for multiple myeloma, a new candidate for non-small cell lung cancer, and even a potential Lyme disease vaccine. Every single one of these has billion-dollar potential. The success or failure of these specific drugs will determine if Pfizer can fill that massive revenue hole we just identified.
Now, beyond the specific drugs, we have to look at their underlying capabilities. This VRIO analysis that our source material provided helps us assess their sustained competitive advantages. Now, VRIO stands for valuable, rare, inimitable, and organized. And what it really shows is that Pfizer's true strength, its absolute bedrock, lies in things that are valuable, rare, and incredibly costly for any competitor to try and imitate. We're talking about their world-class R&D capability, their massive patent portfolio, their regulatory expertise, and their global brand reputation. These are the deep, foundational assets that give them the ability to execute that rebuilding plan in the first place.
Yeah, that's all well and good. So they have a plan, and they've got some inherent strengths, their VRO assets, as you call them. But none of this happens in a vacuum, right? A strong R&D department doesn't just guarantee a blockbuster drug. So to really understand if Pfizer is a solid investment, you have to put it up against the competition. How does it structure, its valuation, its profit potential? How does it stack up against the other giants in the industry? I think it's time for a head-to-head stress test.
This is where the story gets really, really interesting. Look at that forward PE column. That stands for forward price to earnings, and it's basically a measure of how much investors are willing to pay for each dollar of a company's expected future earnings. Now, Pfizer is trading at just 8.9 times forward earnings. That is a massive discount to the peer average of around 13 times. And now, look at Eli Lilly, the darling of the obesity drug market, trading at a staggering 42 times forward earnings. This valuation gap, right here, is the entire debate in a nutshell. The market is paying a huge premium for Eli Lilly's perceived growth, and it's pricing Pfizer like it's a company in terminal decline. And you can also notice its profit margin is lower than most of its peers, with the exception of Bristol Myers, which, by the way, faces very similar patent cliff issues.
Exactly. So this becomes the fundamental question for any investor looking at this space. Is Pfizer a deeply undervalued, discounted powerhouse whose strengths are just being ignored by a market that's chasing hype? Or is it a value trap, a company whose low multiple is actually a warning sign that its business model isn't built for modern growth, unlike competitors like Eli Lilly who have completely captured the market's imagination and all of its capital? The real question is it cheap for a good reason?
All right, this brings us to the final act of our inspection. We've seen the shiny surface, we have uncovered the deep cracks in the foundation, we've reviewed the rebuilding blueprints, and we've stress-tested it against the competition. Now it's time to synthesize all of this evidence and deliver our final verdict. Is it an opportunity or is it a trap?
So, we come all the way back to our original question. We've done the work, we've examined all the evidence. After this complete structural inspection, is Pfizer actually built to last? Can it withstand this hurricane of patent expirations and rebuild for a new era of growth? Or are the cracks just too deep to repair?
Let's break it down one last time. The bull case is pretty clear. You have a company that consistently beats earnings estimates. It pays an attractive dividend, providing a yield that really acts as a valuation floor. It's trading at a rock-bottom valuation compared to its peers. They have a massive cost savings program in place to protect their margins, and they have a pipeline that is filled with potential blockbusters. But the bear case is just as compelling, if not more so. That patent cliff isn't a maybe, it's a certainty, and it is massive. The COVID revenue stream that padded their results for years is evaporating before our eyes. The professional analyst community, represented by that Zacks rating, is screaming sell. Management's own forecast calls for years of stagnation, and it's clearly underperforming its high-growth peers. The weaknesses here are not theoretical, they are quantifiable, and they are imminent.
So here it is, the iron financial verdict. Pfizer is not a house of cards, but it is a structure under heavy renovation. The foundation, its R&D capabilities, its global reach, and its attractive dividend yield, that is still solid. However, the walls are visibly cracking under the immense pressure of the patent cliff and declining COVID revenues. Management has a credible blueprint for the renovation, but the project is risky and the timeline is very long. This is not a stock for the impatient. It's a high-yield turnaround play. You're getting paid to wait, but you must be willing to live with the noise, the dust, and the very real risk that this renovation could fall way behind schedule. Our final word: proceed with caution.